Hello, everybody. Alex Sasso here as your host, and joining me today is Michael Simpson. We're talking about the NCM Dividend Champions product, and today is Wednesday, October 5th, 2022. As always, just some housekeeping issues. We're in Zoom presentation mode, and what that means is that your cameras are off and your microphones are muted. We're accepting questions throughout this session. I will monitor it, but please use the Q&A function at the bottom of the screen if you have any questions for us. Secondly, thank you for all of you that have visited our updated website. We're really excited about it. We've heard a lot of positive feedback on the new look and our expert insight sections, to which this video or this webinar will be posted later on. And for those of you who are not familiar with this product, I wanted to remind you that it was November 2020 that we changed the mandate to a North American focused dividend fund. It was previously called the NCM NORIP Fund. It was one of the country's best performing small cap products. As that client base became older, they had quite a few capital gains embedded in the fund. And now that product has been remandated with Mike's stewardship as a North American dividend focused product. And Mike's been the manager of that, as I mentioned, since November 2020, so about 2 years now. And that might not sound like a long period of time, but I want to remind the audience that Mike's got a quarter century of investing in dividend growers and showing that dividend growers outperform over time. And during this time period, the 2 years that I referred to earlier, Mike's performance has been first quartile, and he's beaten the benchmark as well. The benchmark is 70% the TSX, 30% the S&P 500, and he's beaten the benchmark by 330 basis points per year to the end of August 2022, and he's beaten the competition by 370 basis points per year for that same time period. And he's up, the fund is up 2% year over year to the end of August. But as we all know, September was a difficult month in equity markets, and hot off the press is the September performance numbers. And the fund to the end of September is down less than 1%. So notably strong performance numbers. The other thing that I wanted to mention was that we recently introduced a AA and a FF series. And that series pays a monthly fixed distribution of 7 cents per month. And today, Mike's going to help us with questions like his views on the business cycle, demographics, and the impact that has on the markets, the dollar, bond yields. But let me start by kicking things off. Now, Mike, as you know, and our audience knows, that there's really been no places to hide in 2022, with the exception of perhaps this particular product. Equity markets have been weak, bond markets have performed poorly, but you think that Canada can play a role in the eventual global economic recovery. Can you please tell us how?
Yeah, thank you, Alex. Canada is a country not only rich in human capital, but we have a lot of great resources that can feed the world. We traditionally have developed our resources very well. Over the years, we've added value to those resources. So what's happened over the last couple of years is there's been major geopolitical shifts, tectonic shifts, I would say. Ukraine is still known as the breadbasket of Europe. So Canadian wheat will go to places that Ukrainian wheat can't go, also canola. So we are fortunate and blessed with all the great farms in Western Canada. We have railroads like CN and CP that are great dividend growers that we own in the fund that will take that wheat and canola to the ports of Vancouver or to the ports of Thunder Bay to get to the markets. So Canada is well poised. From its peak, the TSX is down 13%. I know that's correction territory, but the S&P 500 is down 22%. So Canada trades at a lower PE at about 11 times, and the US market is about 16 times. So there's a lot of great value there. So Canada will help in the world recovery based on our resources, which we have an abundance of, and also based on the human capital. And everyone knows we're strong in banking, so our banks will continue to expand into the US. So we'll have more of a continental market. And one of our holdings, CP, is in the process of acquiring Kansas City Southern. And that goes back to my earlier point of changes in the macro are making supply chain shorter. So we will now have an integrated economy between Canada, the US, and Mexico. And a company like CP will be able to take advantage of that to move auto parts from Mexico or grains from Mexico into the United States and Canada.
Yeah.
So Canada is well poised for an economic recovery.
Yeah, no, I totally agree. And a lot of pundits are calling for a recession, and I'm not disputing that, we might get a recession, but I'm going to argue that it's going to be a mild recession. And there's a few reasons for my thought process. One, full employment, not just in Canada, but in the US. And there's not too many times in history you've had full employment and a dramatic or a tough recession. We just had COVID, and consumers saved a whole heck of a lot of money during COVID. Many corporations still haven't normalized their supply chains. There's still a big backlog in a lot of these corporate order books. Corporate balance sheets are much better than they've been in the past few recessions. And then remember, many businesses remain understaffed. So they're going to do what they can to keep their staffed employees, in my opinion. And then one other thing, and this is to your point about Canada being abundant with natural resources, is North America is energy self-sufficient. So in a way, we have a competitive advantage relative, certainly vis-a-vis Europe, but we have a competitive advantage because many of the gas and oil feedstocks are used in many other products and many other chemicals. So our businesses have a relative competitive advantage over the next period of time. So I'm a little bit bullish as to what the medium and long term holds for Canada. And then I know you and I have talked about this in the past, Mike, but just your thoughts on why you've talked about our population hasn't grown during the pandemic. Is that a concern for you?
Yeah, thanks for the question, Alex. So Canada was built on newcomers coming to Canada throughout its more than 150-year existence. So immigration has lately picked up. If you go to chart 11, you can see that. So what does population growth mean? It means these newcomers to Canada will have to eat. So we own Weston, which is an owner of Loblaws and Choice Properties REIT. They will require telecom services. We're owners of TELUS and BCE. And overall, it's additive to the Canadian economy. It's additive to gross national product. It will continue to grow, help our cities grow. They're great cities: Toronto, Montreal, Vancouver, Ottawa, Edmonton, Calgary, etc. So this is just overall good. It helps the nation grow. It helps solve that problem that Alex talked about earlier about some of these jobs vacancies that can't be filled. So right now in the US, according to the latest JOLTS data, there's about 10 million jobs that are unfilled. That's down from about 12 million. Canada, 1/10 of the population of the US roughly. We would have between 900,000 and 1 million. So new entrants coming to Canada, they will help out with some of the job situation where we need workers. So people have to realize more people coming to Canada. Yes, they come to certain cities and certain regions, and ideally we like to spread it across the country. But this is positive for Canada. It's positive for GDP. And it's positive for many of the companies that are in our portfolio. You just don't know it, from the grocers to the rails to the company producing fertilizer. Overall, during the pandemic, because of various restrictions, which were understandable due to containing the virus, but now as things are opening up. We have more immigrants to Canada, and they will go through a learning curve, but they will be productive, and they will add to the Canadian society and the Canadian economy.
Yeah, and 18% of the population today is in retirement mode or decumulation mode, which puts an underlying demand on dividend paying stocks. One of the only ways that you can deal with higher inflation, rising bond yields. And speaking of bond yields, are you concerned about the level of bond yields, Mike? And in your opinion, are they too high right now?
No, if you look at chart 9 and 10, you can look at Canada, where we see that bond yields, the current 10-year bond yield is about 3.20, but it's well off its high in the summer, where we were up to about 3.60. And also keep things in perspective. When you look over a very long time horizon, the average yield of the Canadian government 10-year yield is about 4.53. So we're still lower at a current rate of 3.20 than historical standards. So it's interesting. The equity market often takes its clues from the bond market. So the bond market is saying, yes, we know what the latest inflation readings are, but we're looking forward. We're looking at inflation coming down. So, the 4.56, I don't think we'll get there. I think there was extraordinary measures, both on the monetary and fiscal side, to prevent the economy from going into a more severe recession during COVID, during the lockdown periods. So rates are coming down, inflation's coming down. There's slack in the economy. We have a slightly higher unemployment rate than the US. There are certain regions that are doing better than others, such as Alberta vis-a-vis Ontario. But I don't think, people should not make an equity investment because of inflation. And also within the Dividend Champions, we have certain companies that have proven to do well in periods of moderate to moderate inflation. One example is Granite REIT. Canadians wanting to buy online, and as I mentioned, the growth of the cities has made industrial space a scarce item. It's also put industrial space at a premium. So even though Granite REIT has only raised their dividend by 3%, they have low leverage, a low payout ratio. They're well diversified geographically. And I can go into others, such as Fortis, that's raised their dividend by 6%. More people move to cities, towns, more power. Fortis will provide that. They've raised their dividend every year for 49 years. So think about that as a very consistent, regular, nice bonus to your portfolio. So that's very good, and that's what we look for. That's what we look for in the type of companies we invest in, Alex.
Yeah, every year for 49 years. That's quite a track record. But just getting back to the theme on bond yields that you were talking about, Mike, I think one should note that bond yields tend to drop when US PMIs drop below 50. And it's just some quantitative analysis that we've stumbled across. But each time US PMIs go below 50, that's the Purchasing Managers Index reading goes below 50. Below 50 signals a contraction. Bond yields tend to drop. It's a case where bad news is good news. And if you think about 2022, it was definitely a year of high cash levels in portfolios. And while I think this was warranted, it's my opinion that investors should be thinking about deploying some of that cash opportunistically. Buying price weakness on those days where we see price weakness as an approach, as we approach a period where central banks are starting to ease up on the strong tightening language. Remember, the futures are implying last rate hike will occur in March or May of 2023. There's no meeting in April, so it's March or May of 23. And if you think about the equity market is a forward-looking machine that is usually thinking about 6 months in advance. And we can be entering the territory where markets go up for no good reason at all. And remember, at the bottom of the recession, the markets go up, nobody really knows why. And at the peak of the cycle, markets go down and nobody really knows why. The numbers at the peak are always good, and the numbers at the bottom are always lousy. And Mike, if you think of perhaps this is a question for you. If you think of the last 2 days, it's not a trend, but all we got is lousy news, and yet the markets were extremely strong on Monday or Tuesday. Your thoughts on that?
Yeah, so the central bankers look at economic data. It's, the market's really looking at data in real time, or as close to real time as you get. So as you mentioned, Alex, some of the more recent economic data has been weak. JOLT, which stands for job openings and labor turnover, was lower. As I mentioned, the number often quoted that there was 12 million job openings. Now that's down to 10 million. ISM, Institute of Supply Management, new orders. New orders are crucial because that tells managers, I need to hire more staff. I need to keep the equipment running. I need to buy new equipment. That new orders, ISM new orders is decreasing. The quit rate, how confident are employees in the US? That number is decreasing as well. So you see employees less willing to move. So that would be medium-term, long-term positive to show that wage growth will come down, because if there's less of a concern about employees moving, then that gives managers more confidence that they'll stay, and that the pay increases for employees that work hard will be more in line with inflation. Also, the latest construction spending, that was down minus 0.7 month over month. ISM employment below 50, 48.7. And mortgage applications, a key driver in the US of construction and other economic activity, was down 14%. So all those are things that the Federal Reserve has to consider. So they're using a very blunt, hard instrument to wrestle inflation. It's interest rates. They also have a mandate, unlike Canada, for both stable employment and to bring inflation. And also, and a third one based on an amendment in the 1990s was moderate long-term interest rates. So when you consider all the facts, and the central bankers and the governors in the US of the 12 regional banks, they have a team of people gathering all this economic data. They will have to consider this, and they'll have to show, as many economists are showing, there's a slowing economy. And if you put on the brakes too hard, then you may have an outcome that you did not plan for. So definitely the economy is slowing. Just another point about bond yields. Bond yields often peak going back over 50 years before interest rates. So the bond yields coming down in Canada. US, there's a esoteric issue with a lack of US dollars. The bond yields coming down in Canada does show that the bond market participants who manage billions of dollars are less concerned with inflation, and their view is that inflation has peaked and it'll be coming down to a more moderate level.
And we've already seen that with goods inflation. So goods inflation has come down. Services inflation lags goods inflation, and it's stubbornly high. That's what's keeping the overall number a bit high. But if you believe, as I do, that services inflation will eventually follow goods inflation, the inflation number has peaked and will start trending lower. So I think that will give market participants a lot more confidence about putting money to work in the market. But one of the ways you can fight that inflation, one of the only proven over time ways that you can fight inflation, is by dividend growers and dividend compounders. Maybe just your look on the dividend growth embedded in your portfolio of companies.
Yeah, so if you go to chart 12, you can see, just talking about the subject of dividends, over time, RBC has done great work going back to 1986, that dividend growers vastly outperform the market with lower volatility. I believe you might want to go to slide 11 or 13. So in the portfolio, there is a great amount of dividend growers. I mentioned some of them. Gildan, which is a very boring maker of t-shirts, socks, and underwear. They've grown their dividend over 5 years at 12%. BRP, which was spun out from Bombardier, 1 year dividend growth of 22%, 3-year of 16%. And Tourmaline, and yes, a natural gas player. Yes, resources are more cyclical, but they've grown their dividend by 40% over 1 year, and they paid $2.75 $2.75 in special dividends just in 1 year. I can mention we are extremely disciplined. So January 2022, I didn't want to buy Microsoft because of the valuation. But more recently, on the pullback, I bought Microsoft. They recently increased their dividend by 10%. So I earlier mentioned Fortis, 49 consecutive years of dividend increases. And I could mention a obscure name like U-Haul. You see their trucks and their trailers all over North America. It's a great cash business. They're the second largest player in public storage in the US. And they have this very good habit of paying special dividends. So within the portfolio, I'm very confident. There's only 2 names that don't pay dividends, but it is my expectation that they will pay dividends in the next 2 years, and they generate very large amounts of free cash flow, and that will allow them to buy back shares or reinvest in the business. So the dividend growth outlook of the Dividend Champions is quite strong.
Yeah, and I've talked at length, both in written pieces and some of these webinars showing charts that show the dividend growers tend to be the best performing category, significantly outperforming the non-dividend growers or the non-payers. And certainly,
yes, you could just go to chart 6, Alex. Chart 6 illustrates that.
Yeah, it's one of my favorite charts. It'll come up here in a second, but it just shows how powerful this consistent strategy is over long periods of time. So here you can see the outperformance of dividend growers and dividend payers relative to the TSX, but certainly the non-payers. So for those advisors out there that have a portfolio dominated by non-payers, doesn't mean that you don't own good companies. You just have to know mathematically you have a bit of a headwind as opposed to a tailwind, and that's the beauty of the dividend growers and the dividend payers. My personal favorite, and I know Mike, your personal favorite, is the dividend growers as well. And the nice thing about that is quantitative analysis really helps identify those dividend growers, and then so Mike and I will use quantitative analysis to determine what are the most attractive looking from a pure numbers perspective, and then we'll do the fundamental homework on those companies. But if you can go to the next slide, it should show the volatility or the standard deviation as well amongst the dividend categories. So the beauty of this set of securities that we're focused on with the Dividend Champions Fund is that we're really focused in on those dividend growers. You're getting better long-term rates of return. You're getting more disciplined management teams. You get better downside protection. And by the way, you get lower standard deviations, or how the industry terms risk. So it's lower risk. And then just speaking of risk, Mike, maybe I can throw in a question here is, a lot of Canadian dividend paying companies face challenges from the perspective that their earnings tend to be from a more cyclical earning stream. So how do you manage that risk, the risk side of the portfolio?
Sure. So just the last chart that we had up, that is what I call, for advisors, the sleep well factor. Lower calls from your clients. You sleep well. You don't worry about what we used to call at my former shop, the torpedoes, those companies that cut their dividends. So yes, Alex, when you look at the composition of the TSX market, there's resources, there's financials. So resources by their very nature are cyclical. Within a portfolio of all the different resources, whether it's oil, forestry, base metals, pulp and paper, gold, I never want to have more than 30% of the portfolio in those names. Right now, I've got about 18% in oil and gas, but there are some more less commodity sensitive names within that 18% bucket, such as pipelines like TC Energy, which is very big in natural gas and natural gas liquids, very big with growth projects in Mexico, which is helping Mexico with their energy needs. Also Kiera, which is a midstreamer, Topaz, a royalty company, which has midstream infrastructure. I do own one forestry company, Interfor, which is dirt cheap, which has bought back a substantial amount of their shares, more than 5% of their float, paying special dividends. We'll get a bonus when the US releases some of the tariff money or the customs duties monies from Lumbergate number 5. So the answer to the question, Alex, is you manage a diversified portfolio. It's North American centric. Right now, I've got about 23% of the names in the US. Within Canada, I want to be diversified among many sectors. And there are times where resources will be a screaming buy, but the discipline is don't put 50% of the portfolio in resources, because you may look like a hero for 3 months, but then when the tide turns, you're left with cyclical companies where their underlying commodity can drop anywhere from 20 to 60% in short order. So manage a diversified portfolio, have industrial companies, consumers companies, have companies that are in a duopoly like CN or CP, have companies like Gildan that are leaders in their industry. They're low-cost producers of unsexy items like t-shirts, underwear, and socks. They've simplified they've integrated by buying yarn producers, very low debt on the balance sheet. They can take on the Hanes, they can take on the Fruit of the Loom, and they can manage cotton prices quite nicely. So I like those names, and an obscure name like a new edition Microsoft or a U-Haul. Very steady. They've been in business for over 60 years, but a lot of people don't know it's a public company. So you manage it by using discipline, and you manage it by having a diversified portfolio.
Yeah. Okay. And then we had a question that came through the Q&A portion of the Zoom meeting here, asking about recent data on dividend payers, and I assume it meant performance. And by recent, I assume that meant in the last couple of years. If I could just encourage that person to reach out to the sales team, we can provide some data. There is some data. It is a little bit mixed in the last couple of years in terms of dividend payers performance relative to the broader category. What we were trying to emphasize is the long-term nature of it, and not just a period where you had very strong tech. I isolated segments of the economy that performed really well. Mike, you mentioned earlier just about risk and diversification, and some of your investments are in the US, but that leads me to the question of the dollar and what your strategy is with the hedging the two currencies.
Yeah, the dollar is very interesting. There's many different philosophical views. You could take the view that over time, everything reverts back to the median, but I manage a portfolio that could have anywhere from, I would say, minimum 20% to maximum 49% in the US. It is foreign content, but I have my largest amount of confidence and expertise in the US market. So what I do is, we as a firm at NCM, we hedge, we use 1 month rolling forwards. So currently I'm about 55% hedged. For a while there, I was looking not very good because the Canadian dollar dropped quite dramatically, as there's been a huge inflow to US dollars, and virtually every other currency was not performing well vis-a-vis the US dollar. Canadian dollar for much of the year held up well against the US dollar, but it was only in the month of September that it broke down. So they're 1 month forwards. The point of my hedging exercise is to not to be a hero, not to hit that 600-foot home run. I want to be approximately right as opposed to absolutely wrong. So we hedge every month. Dollar movements can be quite quickly in quite short periods of time. It's not uncommon for the dollar to move 7-8% in extreme moves in the course of 2.5 weeks. So rather than say all my charts, all my fundamental indicators are right, just have a consistent hedging strategy. Because if you don't have a consistent hedging strategy, you are speculating. So I work hard. It's a competitive market. Hedging is to protect against the downside. So even though for parts of the end of September, I was wrong, I was still capturing 45% of the upside. And as the Canadian dollar strengthens on certain days, I'm only capturing 45% of the downside. So the point is to be consistent and be more concerned about the downside than saying you're absolutely right and you nailed the currency, because currencies are very hard. There's men and women who follow it by the second, by the release of every economic data. So just do the right thing and just safeguard the portfolio, and that's what we do at NCM.
Mike, we're up on our 30 minutes. I will ask you one more question, and there has been questions posted about individual names in the portfolio. If I can ask those advisors to reach out to your NCM salesperson, and we'll do our best to connect with you. But we do have a question about the changes to the economy post the pandemic and any recent geopolitical events. So we'll just finish on that question if we can, Mike.
Sure. So pandemic and recent geopolitical events together, we are shortening supply chains. So supply chains that used to stretch from Canada all the way to China, they'll still be there, but we are going to integrate deeper into North America, as I mentioned earlier. A company like CP that can get goods once their deal is approved, we think in March 2023, that'll be a benefit. We're in a new era where I can tell someone where the economy is slowing, so why should some certain resources go up? Because there's going to be a scarcity. Supply is not as abundant as in the past. So we have to ensure as a nation, as the West or as in North America, that we have adequate supply of certain key commodities and goods. And we're going through that. You see in the US spending billions of dollars on increasing semiconductor capacity. So the bottom line is we'll have to do more for ourselves. We'll have to source more from locations that are closer to home. Supply chains will shrink. Supply chains will get shorter. Supply chains will have to be more resilient over time. And that's how the world will unfold. Eventually, the war in Ukraine will end, but then we'll be in a period where that country has to be rebuilt, similar to Europe after the end of the Second World War. And until that time comes, Canada's farms will continue to feed the world in different markets. So the outlook is quite bright, and the future is good for Canada.
And think of the competitive advantage that we're going to have with natural gas prices in Canada relative to the rest of the world. And as I mentioned earlier, that's a feedstock into so many other products, as is oil. So Canada, in my opinion, as is yours, is very well positioned. And thank you, Mike. I apologize to those people that we didn't get to in terms of your questions. If you need any more information, please do check out our new updated website. We're really excited about it. A lot of work and effort's gone into it. Any constructive criticism on it, please let your regional salespeople person know. If you have any other questions, please contact us at sales@ncminvestments.com. Thank you, everybody. Appreciate your time today.
Thank you.